Just to introduce myself, for those I haven't met, my name's Yates. I run the distribution side of the business. Today we're going to have a sort of panel conversation, but I want to keep it very open and informal. So please, throughout, where there are questions, pop your hand up. We'll get to you. We really want to make sure we maximize the time for you guys here. So thank you again for joining us. I've got the 4 portfolio managers with me. On my right is Jacques Conradie. Jacques is our CEO. Justin Cousins is a director and PM. Dave Fraser is our co-founder and chairman. And then Simon's also one of the PMs on the team. Okay, Jacques, to kick off with you. We've got lots of new faces in the audience today, so I thought it would be a good idea just to give some insight as to how we have taken the relatively different view to the rest of the market, in that we've stuck to running hedge as a product, and we've done that for a long period of time. We haven't gone into the traditional long-only space, and maybe you can give us a bit of insight as to why we've made that decision.
Okay, awesome. Thanks, Alan, and morning, everyone. Welcome. I think I'll start with the fact that how all of us see the job we do here, and I guess that the key difference from me is that we are super passionate investors that don't really see this as just another job. Investing is my obsession, and if I wasn't working here, I'd just be managing my own money and following markets. It's what we love, and I think that's what we look for when we bring someone into the business. So if you start with that, you get to a very different approach to managing funds. We effectively see the funds as managing our money, our own money, and managing clients and your money next to ours in the fund. That's what we want to achieve here. So if you start with that, you'll say, how do I want my own money to be managed? Assuming the fund manager knows what he's doing and has a reasonable way to play markets, do I want him to operate with one hand tied behind his back and only be able to buy shares he like? Or do I want him to have the whole toolbox to be able to buy companies you like, to be able to go short when there's shares that will go down, to be able to use offshore markets when there's opportunities there, to be using derivatives when you can hedge the portfolio and protect for various scenarios. So I think that's for us why we think hedge funds is the best way for a manager that knows how to manage markets to operate. It gives them the widest possible tool set to manage. I think the second thing that then comes from our view on investing is we're not chasing assets. We've always been a completely performance-driven business, because I guess our money's in the fund. It's the majority of my personal net worth and assets are in the funds. The same holds for the other portfolio managers. So we are a returns-focused business. We're not going to launch big long-only mandates to attract assets, because what we think that does is, in the SA market with limited liquidity, if you're too big, it just makes you slow. It means you can't change your mind when there's new information. It means if there's a small or mid-cap you like, you can't build a big position. And as a returns-focused business, that will constrain our ability to generate returns. So many of our big long-only, big institutional clients have offered us long-only mandates. And it would have been an easy thing to, in the short term, grow the profits of our firm or our AUM, and we've consistently said no to that. I think we're going to be primarily a returns-focused business for the rest of the time we run money. And also it's the reason we've been closed to new money for about 5 years. At various times in our 24-year history, we've been actually closed to new money because we thought at that time our AUM was at the right kind of size. So, that's maybe just a short introduction on why we think hedge funds are the right tool to compound wealth in the long run. I think what we'll touch on later is why specifically in this set of market circumstances, that's probably one of the most uncertain I've seen in my investing career, why we think it's more important right now than it's even always been. But I thought it's maybe also good, we've got our founder as part of the team, that Dave can maybe give you a little bit of history also on why the firm was started and why we thought there was an opportunity for this kind of model in SA.
Thanks, Jacques. I think going back to the 80s and 90s, myself and Clive Yates, my other co-founder, were portfolio managers at Liberty Asset Management, which in those days was a pretty well-respected investment firm in Johannesburg. And certainly there was some management turmoil at the time, and both of us sat down and said, well, let's look to perhaps do our own thing here, but let's look to take the good things out of a institutional environment and replicate them in our business, and leave the things that we didn't enjoy, that were diversions, that were negative energy behind. And I think that's what we've tried to do at Peregrine Capital. So the one thing we did take, and I think we still have as an absolute cornerstone to our business, is a fundamental research bias, bottom-up research, good hard work in analyzing companies and understanding them, modeling them, and speaking to competitors, understanding the industries in which they work, and coming up with real disciplined research process. So when we do take a decision to buy or sell a share, it is an informed one where we've done as much work as we possibly can, including management meetings and including as much information as we can gather over that. So that's one of the positive things we took with us. What we left behind was really just the sort of administration burden, the meetings upon meetings. We used to see really great ideas come up through the bottom of the fund managers, and then meetings and meetings happened between portfolio managers and senior people within the organization. And the meeting, by the time it got implemented, if it ever did, the share price had already moved. So again, another cornerstone of what we wanted to implement in this business is a very flat management structure, ability to look at information as it came out, and between 3 or 4 informed people to discuss it and act rapidly if needs be. So, we now are 24 years into the process, and I must tell you, we started with a one-pager of our sort of investment philosophy and the things that we held dear. And really, without exception, all of those points are absolutely relevant right now in this business, as they always have been. It's about a flat structure, disciplined research, and taking the good things out of an institutional environment and leaving all the bad things behind. Meeting after meeting, deciding what to do or what not to do. That just is negative energy. If we've got a decision to make, we sit down, we analyze the information, and we make the decision and back ourselves and execute into the fund. So I think what's really exciting for me is the business is obviously bigger and there's significantly more people, but those cornerstones on why we started the business are probably more relevant now than they ever have been. So, I mean, it really has been a great journey and a great, I'm very proud of the business where it is now, but it's interesting how those cornerstones are absolutely been consistent, and we really haven't changed anything since we started.
Thanks, Dave. So, Jazz, maybe onto that, it's a good segue. So that flexibility, that ability to respond rapidly has obviously been incredibly important for us this year, given how challenging markets have been and the way information and markets have moved so rapidly. Maybe you can just give us an idea on your guys' thinking over the past 9 months, how you've been positioning the funds, and how things have moved over that time period.
Yeah, it's an interesting one. I think we want to focus firstly on how we have been positioned, and then where we're looking for opportunities going forward. Historically, for the last 9 months, we've been sitting on very, very low levels of overall market exposure. I think that's informed by the fact that we are very concerned about the overall macro environment that we see. So, I mean, you're all aware of the fact that inflation is now spiking and is at the highest levels that we've seen in probably 40 or 50 years. And that comes with increased interest rates. And increased interest rates obviously impacts, firstly, consumers, but then impacts the earnings of companies, particularly companies with debt on their balance sheet. So the overall market outlook or environment is particularly poor at this point in time. We've already seen big drawdowns in the market. And, despite that, I don't think we're particularly excited to materially increase our net exposure at this point in time. But where are we looking for opportunities? I think we really are looking for uncorrelated opportunities within various markets, so we can take advantage of, we can make returns without relying on the overall market direction. So things like pair trades are very, very important at this point in time. Looking for arbitrage opportunities. We've had fairly big exposure to the energy sector for the balance of this year, although that's sort of reducing at this point in time. And I think another area of differentiation that a lot of other people don't look at is in the corporate bond space. So many of the companies that we know very, very well in these type of environments, you typically see a lot of forced selling taking place in many of these bond funds, indiscriminate selling really, and that's a fantastic hunting ground to be looking for opportunities in the bond space. And I think those opportunities are only really starting to emerge at this point in the cycle. So given where we're sitting, this conservative net exposure that I referred to, we really are well positioned to take advantage of opportunities when the markets inevitably do dislocate going forward. So I think we're quite excited about where we are, but it's quite clear that this is a market where you have to turn over many, many stones and kiss a lot of frogs to make sure you're finding the princes and princesses out there that are going to generate those returns for our investors. So, to Jacques' point about size of the asset base that we manage, it's not that we get less of our calls wrong than a typical asset manager. I think we do get a lot wrong, but where we have an edge is the fact that we have a much smaller asset base, and we actually have the flexibility to change our minds. So when we do get it wrong, we can actually pivot and sell our shares if we have made the incorrect decision, which I think provides a fantastic backdrop for sort of hedge fund type of returns and positions in this market environment that we currently see.
So can I maybe add a specific example there, Justin, to just give you some idea of how our thought process would have gone this year. So clearly the big event was the Russia-Ukraine invasion. That kind of made us sit down as a team and rapidly think through, let's go through everything in our portfolio, let's see what must go out given this new world and what must go in. As Justin said, you want to run higher cash balances because you've got to admit like there's stuff that can happen that I don't know about, both in the war and the China-Taiwan situation. There's just lots of risks around. And the key thing we saw coming out of the war was we said, is there any way we can put something in the fund that will protect the portfolio in case this is not a 2 or 3 day war, but a multiple week war, and it obviously has ended up being a 6-month war with no signs of stopping it. And at the time, so I guess that's what we do. When there's a big new global event, we sit down as a team and we try to figure out, like almost just try to solve this puzzle, what's going to protect the portfolio. And what we came out was that the main constraint here was there was going to be sanctions on Russia. What's Russia's biggest export? It's energy. They're a massive part of the global energy mix. There's going to be a shortage of energy. That was our thought process at the time, and we thought, how do you implement that? We thought coal was the best way as an African investor to put that in your portfolio, because coal is something that's very hard to substitute. Oil, you've got these massive global tankers, so if you sanction at one place, you can move the tanker around. But coal is very bulky, it's very hard to ship, it's very hard to redirect, it takes trains, it takes kind of lots of loading capacity at harbors. So I guess Thungela was then our best way to play it. And it was interesting the behavioral issues we faced, because we bought Thungela 2 days after listing at 25 Rand. It had then run to like 100 Rand a share, so it's up 4 times. So we're obviously selling. I think we've sold like half our position. We're quite happy. We've made 4 times our money. And right there, we sit and realize, okay, we actually need to own a lot more of this. So then you have to go turn around, pay 10 or 20 Rand more, actually try to get all those shares back and then more that you sold, despite it being up 4 or 5 times from where we put it in. So I guess it's important to have a small team, to not be stuck in these natural behavioral biases where you want to pay more for something that you just sold and also something that's up a lot. And I guess fortunately in a small team where we carefully guard against those, I guess, behavioral impediments, I think we made the right decision there. So that was a huge winner for us this year, and I think it's a big part of the strong performance. But then I guess another lesson we've learned is you can't become married to a stock. So it's very easy to fall in love with a stock, to never want to sell it. I think the last 2 or 3 weeks, given that this story has worked, we've had the discipline to say, let's bank 80% of this, 80 or 90% of the position. It's gotten to our target price, even given the constraints. You've got to make peace with the fact that it could continue to run, but I guess that we think that money is best served in cash right now, sitting ready to redeploy if we find attractive ideas, which inevitably every few months there's something great that gets added.
Then maybe if we just touch on the South African economic situation quickly before we move on to maybe more global topics. I was listening to a Stanley Druckenmiller interview this morning, and he was going on about how he gets all his economic data from corporates. He doesn't pay any attention to anyone with a PhD. And I think that does resonate quite well with us as a business in terms of how we try and gauge the health of the SA consumer. So Sai, maybe you can elaborate on some of the meetings you've been having recently, interactions with corporate South Africa and what that's been telling us.
Yeah, sure. Thanks, Alan. So from my side specifically, I focus on the consumer. So what we've seen recently is there's been a clear disconnect between the macroeconomic and what we're hearing from companies on the ground. So in the current environment, what you would expect to happen is rising inflation, rising interest rates, consumer discretionary spending coming down, and consumer sentiment coming down, which negatively would impact the retailers eventually. But speaking to the retailers on the ground, that doesn't seem to be the case at this stage. So we had a conference last week in Cape Town where we spoke to most of the retailers, and all of them are saying that the consumer is actually still performing reasonably well. Now, the reason for that in our minds is that South Africa is or the South African consumer in general is accustomed to a high level of inflation. So if we compare the SA consumer to the European and the US consumer, for instance, in Europe and in the US, there's been a 4-fold increase in the inflation that they're experiencing. Where in SA, what we've seen here is the range has moved effectively from around a 3 to 5% inflation to a 6 to 8% inflation. So even though there is an increase, we are a lot more accustomed to operating in a high inflation environment. Then secondly, during COVID, there was a very high degree of increased savings from households, and that has buffered the consumer to a certain degree. And then thirdly, what we've also seen is that the informal sector in South Africa seems to be booming quite nicely, which is quite positive for the consumers. Just to put it into perspective, formal retail is effectively around 450 billion rand in total revenue, and it's estimated that the informal retail sector is anything between 250 and 300 billion rand. So there's a lot of economic activity that isn't measured, that we don't really know how to quantify, and that kind of puts the consumer in a better position than what you would have originally thought. Now, speaking to the corporates, one corporate specifically, Shoprite, which is a good indicator of the consumer in general, have mentioned that there has been a slight buy down from consumers, where consumers are effectively buying more on promotion, but that the inflation really hasn't hit as badly as what people would have thought it has. Now, there is obviously risk that inflation does increase over the short to medium term, and we are relatively cautious on that. But at this stage, we've been pleasantly surprised to see that from a retail perspective, these retail companies are actually performing quite well.
Simon, maybe I'll add, also seeing the banks there to just give people some insight into the macro. I think that's also, for us, always a very good indication of how people are doing, whether the impairments in the banks are trending upwards. And I guess, interestingly, similar to the retailers, they just haven't seen that. And I think it's probably a combination of middle and higher income consumers building some savings around COVID when there was less expenditure, and that not having been fully depleted. Rates still a few months ago was fairly low in South Africa. And then specifically for the banks, they're all very well provided against bad debts. They made a ton of provisions around COVID. We end up never needing them. Things recovered much more quickly. So they're sitting with excess provisions on their balance sheets, where even if things get a little bit harder in the next 12 or 18 months, we think they've already got more than enough provisions to stomach those higher impairments. And the other interesting thing about banks is, because they sit with all of your deposits in your current accounts paying 0 or 1% interest, when rates actually go up, that they get kind of, rather than 4%, they earn 6, 7, 8% on those on the interest. So it's obviously not great for consumers, but they typically make a lot more money in times when rates go up because of that. And also the valuations are just very cheap currently. Like the banks are trading, most of them are like 6, 7 times earnings, 8% kind of dividend yields, and typically throughout history they're great buys at those levels. So it's probably one of our biggest net exposures in the funds right now, or the SA banks at current prices. It's probably not a kind of a 3 or 5 year hold for us, but we think there's easily somewhere between 10 and 30% upside there. And those are the kind of opportunities we're looking for right now, where you can make 10, 20, 30%, but being willing to trade them going back to cash when they get to fair value. We don't think it's a market where you can just stay long and strong for the next 3 years and expect to do well.
I think just following on the inflation sort of situation, clearly we've been used to inflation in this country for many, many years. And some of my grey-haired colleagues from the 80s will remember, we were running 20% inflations, 20% interest rates in those days. It's a playbook that certainly our industrial companies and our retailers and all our companies in South Africa have. They understand inflation. They've been used to it. It's come down recently over the last decade or so, but double-digit inflation is something that's not necessarily new to South African companies. We have a playbook. We understand how to manage it. We understand good companies understand how they need to recover that through their pricing. And I think to some extent it's a test on the quality of the company's franchise. If you're able to pass that on to your customers, well, clearly your product is relevant and what you're selling is something that people just need. You can't wear that margin squeeze. And I think that's what we're seeing right now, is that when we are investing in South African companies, it is companies that we know have an ability to pass on any inflation that comes to them, because they have something that is important and something that is relatively easily sort of pushed through in pricing. A sector which seems to be quite exposed right now is the food sector, for example. They've had massive input costs, whether it's in raw materials or packaging or transport, and they are really struggling to get that through to the retailers. You've got a very strong customer base. Simon mentioned Shoprite and Pick n Pay, and these are very powerful customers, and that's a struggle. So that's a sector that we find at the moment relatively unattractive, where you are having almost a structural margin squeeze there and a real inability to pass on the full input cost into companies. But I think if we look at US companies who really aren't used to inflation, certainly not in the last 20 years, this is a real kind of sea change. And I think in both Europe and the US at the moment, these companies are struggling with how to manage this animal that they really haven't been accustomed to. Whereas in South Africa, it's something that rapidly weakening rand obviously sparks up inflation. We've just got a playbook in South Africa that companies have used many, many times, and I think the good companies will use that playbook again in this inflationary environment. And again, historically, equities is actually a really good place to be in an inflationary environment. It gives you the protection you need. It gives you the sort of earnings should grow at least in inflation, and good companies should be able to navigate that sort of environment and give you the sort of real money protection that everybody's looking for in an environment of rapidly rising inflation.
So maybe you can expand on Dave's point there, just around American businesses that have struggled. I mean, I know you cover the payment space, and that's an area we think isn't going to be affected by that. Maybe just give your insights there.
Sure. So just in terms of the payment space, we typically invest in the networks Visa and MasterCard. So we see them as some of the best inflation hedges out there. So normally that is due to their revenue structure and the revenue model of the businesses. So effectively what happens is every time a transaction is processed on a Visa or MasterCard network, they effectively take a percentage of the gross dollar volume, which is effectively the nominal spending, and that captures inflation. So as inflation rises, they effectively take a fixed percentage of a larger amount effectively. Now these businesses have very high margin structures, so in a scenario where inflation is captured on the top line, your cost base has already been depreciated and has already been invested in. So your network is effectively a fixed cost, so any incremental revenue that comes to the top line filters through to the bottom line. So effectively, in a scenario where inflation rises, your top line would benefit, and then your profitability would increase more in this type of environment, which we think is quite beneficial for the businesses over the long term.
Cool, thanks. So Jacques, then maybe just given the disparity of potential outcomes, the fact that we've got 3 or 4 events happening at the moment that could normally, one of them could push us into some sort of bear market, how are we positioning the funds with a view to the next, 6, 12, 18 months, given all of that?
Look, I mean, it's clearly hard right now. I mean, we look back at the 70s or 80s, which was the last inflationary period like that, and it's hard to actually protect the purchasing power of your money in those times. Like I think over the decade, equities, I think inflation was like 8 to 10% or something on average in the US. Equities gave you 4 or 5, so they were still positive nominally, even though there were a few big 20, 30% down years, but you lost 5% real per annum. Obviously, bonds got just absolutely killed, similar to what we see this year. You're just going to lose massive real purchasing power if inflation stays higher in investing in bonds. And then even cash, typically, because initially it lags inflation, even cash was negative real. So we don't think there's just one simple thing where we can say do this or do that and you're going to outperform for the next 4 or 5 years. The key comes down to the flexibility and watching things and watching conditions evolve and taking action quickly at various points in time. So as I said, right now, we think we're potentially at the early phase of this where it's uncertain whether inflation can get under control, whether we stay at 4 or 5% and it means higher rates for longer. And probably the key things worrying me is how long this war continues, the fact that there is this global energy shortage and the potential massive recession you could see in UK and Europe. I mean, just imagine your electricity bill a month goes up 5 or 10 times, and that's what these people have to deal with. Like, I mean, companies are just going to die. There's just companies, if electricity is too big a portion of your expense line, you're just going to close shop. So, I mean, that's just started happening in the last few months. So it's very uncertain to us exactly how that feeds through the economy if these kind of plants start shutting down. And then I guess this continual build-up of conflict between China and US and the fact that China's now powerful enough to challenge the US, yet they've got this different value system, an authoritarian regime. We don't know if anything there happens in the next year or the next 5 years, but it's certainly to us a significant tail risk. So yeah, as I touched on earlier, we think it's a market where you want to trade more actively, you want to take advantage of opportunities, but then bank those gains, go back to cash, You want to be able to move quickly. If something negative happens, be able to react quickly, see where in the portfolio we need to cut, where we need to add. And then as Justin touched on, we are finding some nice, interesting, uncorrelated type opportunities that is almost a company-specific workout event. I mean, we can't really talk about some of these right now because we're still building positions, but that's somewhat not linked to the global economy, but linked to that specific company executing on a strategy or restructuring things and performing. So we think those opportunities are going to be supremely valuable, where we can make 20% IRRs for our investors, kind of regardless of what's going on in the world. And then I'm sure we're going to find more Tungelas or similar big winners that we've had in the past by just looking hard and hopefully identifying the trends before the larger managers do.
Has anyone got a question at this point before I keep droning on with mine?
Where are you seeing shorting opportunities at the moment?
So we effectively, how we think about the retail sector in general is implementing pair trade specifically. So for us, one of the key shorts over the last while has been being long ShopRite short Pick n Pay. So in a scenario where ShopRite through Checkers 60/60 is gaining so much market share from the other retailers and outperforming the other retailers, we just see them as a force to be reckoned with. Whereas Pick n Pay recently went through a management change, a redesign of the whole strategy, and that comes with a lot of implementation risk in the businesses. So that is one that has actually worked out for us quite nicely in the retail sector specifically.
I think it's important to touch on the fact that shorts are not just shorts that go to zero. We're also looking for these pair trades that Sai's talking about. And I think there's also great opportunities to look for, I'd call them arbitrage opportunities, but a great example of this is the Process announcement recently that they were going to be selling Tencent shares and buying back their own shares. Now, this is a proposal we sent to the company back in 2018, so we're fairly well versed with the actual mechanics as to how it would work when the share was trading at this sort of discount to its NAV. But when they announced that specific trade, on the day we absolutely climbed into Process. We bought as many Process shares as we could, and we short sold Tencent against that. So effectively, you just have exposure to the rump assets, and you benefit by the buyback accretion that is taking place. So effectively, they have 100 Rand they're selling today, and they're buying that same 100 Rand back for, at that point in time, 55 cents in the Rand. So it was a completely risk-free arbitrage trade where the higher the discount goes, the more shares they're buying back and the more value you get on a per share basis as a shareholder. And conversely, the lower it gets, the less upside there is. So we had a fairly big pair trade on in that respect, long Process, short Tencent, and we unwound a lot of that when it got close to sort of 30% discount to NAV at a Process level, and you have started to see that sort of widening again, and we've been sort of rebuilding that position. So that's something that's very, very useful to take advantage of in these type of market environments.
But we have a very small position in non-correlated shorts at the moment. I think the market levels, generally companies are relatively cheap, and there's nothing at the moment that we would say is a real hot kind of something that's going to go to zero. So we don't have any of those in our portfolio as we sit right now. Markets are relatively cheap, and I think you've got to be relatively careful to go uncorrelated shorts at the moment. So it's probably the smallest as it's been in probably a number of years. So
to just add to Justin's example, I think it's a great one, Justin, because basically on that announcement, we had a small position, the pair on. Like most people, we'd been waiting for this forever. As Justin said, we waited for this 5 years. So eventually you just get tired of waiting, and we didn't have much on, unfortunately. But given our size, we could literally put 10% on in 2 days there, and effectively made 20% pure alpha on that 10%, which is 2% of alpha for clients. Where if you're running 200 billion, you can't move. You can maybe put like a percent position on, and you make 20 basis points. So I guess being nimble when those things strike, interpreting it first, like literally you've got 8 to 9, you've got an hour to make the call here. So we go through everything, and I guess there's no investment committee meeting. We just sit next to each other, solve it, and then effectively trade. So you've got to have that kind of setup, I think, in this market to almost just be a bit more scrappy and pick up these 1 or 2% where you find these kind of opportunities.
Touching on your comments on Visa's top line being sort of protected with inflation, right? I think the counter argument could easily be with globally rising interest rates just taking discretionary spend out of pockets. That definitely has a big impact on turnover. But the sort of the support line for that would be, or the flag for that would be to say, when do I buy Visa? is that not when we see the Fed maybe showing signs of this front loading ending? Because it might be the case that interest rates just get front loaded hectically, aggressively, and then there's an absolute pause, and maybe in the next 2 years, a regression already. So what would be your flag in terms of timing a Visa purchase or of uploading more on Visa? Because obviously the counter is rising interest rates takes out that turnover potential.
So from our perspective, we are valuation based. So we would typically look at the valuation of the share compared to the history of the company. So during COVID or during the pandemic, what effectively happened, interest rates came down significantly, discount rates came down, and there was a massive re-rating in a number of these shares. I think Visa and MasterCard, from a PE perspective, they peaked at around 35 to 38 times forward multiples, which is quite expensive. And historically, they've traded closer to the mid-20s. So for us, given the rise in interest rates, they have derated now recently. So we're in a position now where Visa, I think, is trading on a 22 times forward and MasterCard on a 25. So it's way more in line with history. And for us, that would be a indication of the margin of safety to potentially buy the stocks again. So we have actually been increasing the exposure to the payment sector just due to the valuation looking attractive at current levels.
I think it's also important to mention the fact that, given our sort of bearish view on the overall market, we've also been hedging a lot of the incremental Visa and MasterCard buying we've been doing with an S&P index short, for example. So, the valuation risk and a lot of the risk you refer to with respect to discretionary spend would also be captured in the short component through the S&P index short. And a lot of those businesses don't sit on net cash, have got much lower margin structures, don't necessarily have the same pricing power that Visa and MasterCard would have. And I think the pair trade that we've got on an incremental basis makes a hell of a lot of sense to us. So we haven't been adding net exposure, although Size owned those positions for the better part of the last 5 years and continues to be very positive on their outlook, but very much positive relative to the index, I think, as well.
How are you guys thinking about China? On the one hand, there's a lot of risks there, including property sanctions, run of banks, lockdowns. On the other hand, they're counter-cyclical, where they are stimulating the economy. So they're cheap, but seems to be a lot of risk there. How are you guys thinking about that?
Yeah, so I'll take that one. Good question. The macro environment is very, very opaque in China at this point in time. It's as clear as mud. And I think last year's experience with respect to the crackdowns from a regulatory perspective has really it created a significant overhang on the shares, and that's obviously resulted in the compression of these valuations that we've seen. But it's quite a funny one. Dave's always been saying to me every time I come and I speak about Tencent, I keep telling him it's on an 18 or a 20 PE or whatever the case is, exits investments. And that's despite the fact that the share had contracted materially. What is the read from there? The read is that the earnings have actually come down by 20 or 25% as well. So if you're banking on a mean reversion from an earnings perspective and saying that revenue outlook is going to improve and that margin structures are going to get better going forward, then Tencent is potentially a fantastic investment. But it's very difficult to have conviction in that at the moment, given what's happening with the broader macro picture in China. Now, we're not macro experts, and it is just hard. So, at a portfolio level, our China exposure is currently sitting at about 3.5% on a net basis, mostly exposed to JD.com and NetEase. We do have a small pair trade on at the moment with Tencent versus the index, because we do think the outlook is improving over there, but it's not improving fast enough, or we don't have the conviction or clarity to actually go and build a substantial position in that sector or in Tencent in particular at this point in time.
So maybe 5 years ago that would have been maybe in the teens?
Yeah.
So it just tells you that certainly China is a little bit of an enigma right now, and nobody really knows where this thing is going. So we've got a position, but it's significantly lower than it was maybe a number of years ago. So we really, the messages and signals that they're giving, interfering in business in the same vein, saying they're really encouraging foreign investment. So it's a very mixed signal and very difficult to read. So from an investment case, it's increased the discount rate and the cost of investment in China. You need a higher hurdle rate to be there. They say they're investor friendly, but some of the actions they've taken have been incredibly investor unfriendly. Therefore, we have to take our weighting down or make sure that we're getting compensated for that risk. And that's why the weighting in our portfolio is down significantly over the last 4 or 5 years.
I mean, it's interesting in our interactions with Tencent's large shareholder, as well as some of the sell-side analysts that we're speaking to at the moment, the government does not want two centers of power. And you've seen almost a political center of power develop and an economic center of power develop next to that political center. And the CCP is, particularly under the leadership of Xi Jinping, they want absolute authority and absolute control over the economy and over the political domain. So I don't think they want big companies. And you've even seen very big changes in Tencent's rhetoric in terms of their capital allocation policies. They're saying, we're going to give you more dividends, we're going to give you more in the way of buybacks, we're going to get smaller in market cap terms, and we're not necessarily going to be this all sprawling octopus that we were assisting to grow the economy in China, as you have been for the past 15 years. So there's been a substantial change in the rhetoric and the outlook from the company. It's still my favorite business in the world, and I've learned so much from them, but it's so difficult even for them to operate in the current environment, and it's hard for us as South African investors not sitting there to go and build conviction in China generally or in Tencent from a bottom-up perspective as well. It's hard.
Any other questions? So I mean, I think one from my side, Jacques, maybe you can field it, but given that we are a multi-asset business, I mean, we've obviously spoken a lot about the equity markets at the moment, but in the current environment, how important is that asset allocation to the funds? Also given maybe that we've got two very different funds looking to achieve very different goals, and what kind of opportunities are we seeing outside of the equity space?
Cool. Thanks, Alan. Yeah, so I think we kind of take a view at the macro picture, and then we overlay that with our bottom-up research. And you've got to decide what kind of environment are you in. Are you in an environment where you just want to make maximum returns, the environment looks good, things are trending up? And I think since mid-2020, after COVID with rates at zero, that was the kind of world where you almost want to go after opportunities. Where we think you're right now, and probably stay for an extended period, is you must protect investor capital first and foremost. That's the main goal. Try not to lose money and then go after opportunities to make money. I think Dave always says that if you can cut out the big losers out of your year, you already start 5 or 10% ahead. So that's certainly the time frame we're in. Avoid losing money and then take advantage of opportunities after that, because I think it's an environment where if you can protect investor capital and generate alpha on top of that, I think you're going to beat the vast majority of peers. So that's kind of the bigger picture framework for using the asset allocation. As I said, we've got a bigger cash weighting right now than we've probably had for 5 or 10 years. While cash doesn't beat inflation, in SA at least it's giving you not unreasonable rates right now, and it gives you the liquidity to deploy quickly into these Naspers kind of opportunities that Justin mentioned and other ideas. So we're running bigger cash. We have started making some allocation to SA government bonds with a 10-year now close to 11%. We think that's a pretty good place to start allocating, but we haven't gone big yet. I guess you probably want some sign that inflation globally has potentially stabilized, or that the world has gotten inflation under control to be comfortable there. And then probably around 50% equities, around 5-6% property is broadly how we're positioned now. I think we would look for opportunities to increase that equity exposure into significant weakness. But right now we're saying, let's just be disciplined. Let's run that big cash pile. If we find good ideas, what we're doing right now is we're adding them, but we're hedging them with index shorts or specific shorts. So trying to capture alpha, but not beta. We just don't think it's likely that you get rewarded for just being long the market in this environment. We think there's going to be bear market rallies, but there's just enough reason to, I think, be cautious on your beta. You want to be like we were in COVID. If you are well positioned going into a big crash, you can be the one buying the low. If you're overexposed going into a crash, you're always panicking at the low and then you're selling at the low. So we want to be the guy sitting on cash. We're almost welcoming things to come down, and we'll happily deploy into that weakness. That's the kind of mindset we see right now. Obviously, don't take that as fact for the next year. We're going to look at the data that emerges on what happens with inflation, what happens with the energy crisis, what happens with rates, and that view will change. But that's currently where my head's at on asset allocation.
Sorry, just a little bit further on that. If I
possible to give us an estimated asset allocation on the cash and bond portion at the moment in the funds?
So if we look at, I'm just going to give you guesstimates as these things change, but let's say growth, very roughly, I think we're around 35% SA equity, 20% offshore equity, giving you about 55 equity. Around that, to take 5 property, that's about 60 there. Then we've maybe got about 5% in various kind of special situations, opportunities, that's these uncorrelated type ideas. So then we're at say 65, and I think probably off there, maybe 5% bonds and then 30% cash would be kind of a rough breakdown where we're sitting right now. So as I said, a kind of big cash balance. And then market neutral would be much higher cash because we're only 20% net exposure there. We're probably 50% cash balance there, maybe 20% net exposure. I think we're about 10 bonds, kind of 5 or 10 in the special situations, and then kind of 5 to 10 in property. Would be kind of a rough breakdown. But again, that can change. It's come down a bit in the last week as we've sold a lot of our Tungelas, where we've just had that discipline. When it got to our target price, we've been moving to cash. But yeah, I think that's where we're roughly sitting right now.
So our final question then, Dave, for you. I wanted to get your insight in terms of what you think makes a good portfolio manager. What are the kind of qualities you look for when you hire in the team, and what you found to be important over the last 24 odd years?
Okay. I think having a team dynamic is incredibly important. I've seen it many times where, because we sort of do our own sectors, we sort of specialists in our own sectors, but we certainly know each other's sectors enough to make decisions and to engage constructively on them. So I think having 3 or 4 people or 5 people who are aligned and are deep specialists in their sectors and have the ability to cross-pollinate ideas into everybody else's sectors is a very important. I think by having one person making decisions, that never really works. We have worked our fund from the beginning on a consensus basis. We try and get a consensus decision amongst us. And generally, while it's not always the easiest way to go, it's generally been a very positive and a very constructive way to manage the fund. I think that what's interesting, if we look at over the 22 or 24 years we've been going, every sector has its chance, or every person has the chance of making the running. And I think because we put all of our positions, our forecasts and our expected returns onto one spreadsheet, we can see, for example, the banks all of a sudden look like far better value than any of our other sectors. So therefore we will go to Jacques and say, Jacques, it's your running now. The banks look like a real standout opportunity right now. Let's deploy more capital into that. And it's just amazing how that running moves across the different sectors at different times. So I think that's a very important success factor in our business, where we've had 4 or 5 people who understand fund management, who cover their own sector and have different times of effectively making the running for the fund. And sometimes someone else's positions are just far better than the opportunity set that you've got. And it's not about saying I need to have my positions in the fund. We need to have the best positions in the fund, and that's across the whole spectrum. And I think that's what we do particularly well. That we really do pick the best positions for the fund. I think we try and kind of leave the egos at the door. I think that it's about just making the best possible decision for the fund. We all are, as Jacques said before, very significant investors in our fund, and this is what we do. This is what we do for a living. This is what we want to do. It's our passion. So I think it's important to have what has been one of our critical success is to have 4 or 5 people who have the ability to engage on a very professional level about situations that come up all the time. And sometimes those conversations are not particularly easy, particularly say if a position is going against someone and somebody has to go and say, look, it's time. We put the line through this now. It's not worked. I don't think it's right for the position. And I think we all feel a little bit battered and bruised, but the next day we're back at work and we're on the front foot again. So I think it's important to have that sort of mix of responsibility amongst the top 4 or 5 where we generally really do get to the best decisions most of the time, which I think is certainly, in my experience, better than perhaps having somebody who is listening to everyone and just calling things as a sort of casting vote. We've never had anyone who's had a casting vote here. If there's been dissension, we try and engage positively. What are our concerns? Why are they there? And then the person who's proposing the position will go back and try and do some more work. Can I allay your concerns? Are you right? Maybe it's something I haven't thought of, or maybe it's something we disagree with. But I think that type of dynamic where we're really just trying to get to the right answer is something I think that has really held us in good stead. I mean, and we've seen some markets in 24 years. I think the Asian crisis was in our second month of operation. So, the market was down 35% in the second month of our operation. So I think, we have been battered and bruised, and we've seen a few cycles before, which I think certainly helps the psyche. And yes, investments are highly uncertain at the moment, but at the end of the day, I mean, as Jacques says, I love having cash. To me is kind of a dead asset. It's there to be deployed. It's there, the ability to deploy cash on a very quick basis when opportunities arise is the real asset of cash. We talked about Thungela, which has been one of our big winners over the last 18 months. It didn't exist 15 months ago. Sorry, 15 months. It didn't exist. We never, if we'd sat in front of you and somebody said, how are you going to make your money the next year or two? Thungela wasn't even, it came late. We picked it up late. But we did a lot of work very quickly and understood that the optionality of getting something like Thungela, where the parent company was guaranteeing the coal price for the first 2 years, it really just was a call option on the coal price. And we knew that the ESG people would effectively sell the share down. We knew it would be insignificant in the portfolios. So we very quickly planned what was going to happen there, and it played out exactly how we did. Now, the Ukrainian war, we didn't plan. But, it was another up leg to a scenario where we felt that there was a sort of call option on coal and energy. So these are the opportunities that you can't predict or plan, but sure as night follows day, they come up. And as I sit right now, very comfortable with having a nice pot of cash in the portfolio. The risk is we spend it too early, so we've got to be very selective and we've got to watch what's happening. But in a market like this, where there's such dislocations and such volatility, these opportunities are going to come up. And I think it's very heartening to have a nice cash position right now, ready to be deployed in these opportunities when they do, as they will, present themselves.
Just to add to what Dave said, I think another key skill you want to have in your portfolio managers is being able to invest and see the future. If you invest in the present, you can never outperform the market. The present's already priced into the shares. So when you watch Bloomberg or CNBC, they're always talking about what's going on right now, but that's by definition already in people's expectation and priced into markets. You've got to be able to see what happens 3, 6, 12 months ahead and invest for that, and sometimes even longer. I mean, if you take maybe like an example of Capitec, for example, when we bought it in 2010, 2011, they had less than 1% market share. Like it was basically no one had bank accounts. But by looking at the value they were offering, the quality of the service, how much the clients that had the product loved the product and were telling their friends to use it, you could imagine a world where they could get to 15 or 20% market share. And that's the stuff that's not priced into market, seeing the futures before others are. Now, I mean, they've actually gone to 40% market share, so they've massively overshot even our bullish expectations at the time. But I guess So it's just a careful thing. People always love talking about the present, but your job is really finding things in the future that you have more certainty or conviction on in the market and investing for that. And inherently that is hard, and that's why we have periods where we underperform, because no one can forecast the future with certainty. But that's why it's nice to have a group of smart people to work with. We're all better off for it having each other than just one or two people doing it, because all of us see different things. And I guess at the end of the day, when you debate it out and have the fights and get to the answer, that's better than any one person could have. And I think that's what's worked for us over time, and why, despite periods where we don't perfectly call things, I think almost over all time periods, that outperformance has shown in history.
We have discussions, not fights, say Jacques.
Just discussions. Sometimes they get feisty, but robust discussions.
But I think it generally gets us to the right answer. And while sometimes it hurts and sometimes you go home a little bit bruised, by the next day, you're over it. And, sometimes you sleep in it and come back and say, well, I think we did it was the right decision, and I understand it, and let's move on. And so many of those things in hindsight have been the right call. I think the anchoring to a bad call is something that we And as Jacques said earlier, the big losers, that's what we've got to avoid. And I think in this, certainly the last year has been one of our sort of tick boxes, is we haven't had the big losers. We haven't had things that have drawn down very significantly, and that just helps you. It just, as I said, as Jacques said, we start like 5 to 6% up every year if you just don't have those big losers in your portfolio.
I think it's also quite significant that you have your own capital invested. I think that's currently underestimated.
Yeah.
Yeah. I mean, I very, very much agreed. Like, I think you come in there and you said, this is how I want my portfolio to be set up. I don't want to lose money right now. I think the opportunities will come. Let's be defensive. I think it's a different mindset than, we had this conference where the whole SA asset industry was last week, and most of the people there, I think they're hard workers, but it's just, I guess, jobs for them, and you work for some big company where it's owned by a bank or an insurance company or someone else, where I think here, all of us are shareholders in the business. It's our money, it's our business, it's our money invested with clients. I just think it's different to how hard you work and how deep you think when that's the case.
Philosophically, it's something we look at or look for in companies we invest in as well. So, if the guys are buying their own shares and eating their own cooking, it tells you a lot about how they are aligned with you, but also see the future and to what extent they're putting their own money on the table to go and benefit in the years to come. So I think alignment is absolutely critical in whatever industry you look at, and it's definitely something we believe in ourselves, but also look for in companies we invest in.
Right, I'm conscious of time, but thank you all very much for joining us, and please join us outside for a bit of lunch if you've got time to spare. Thanks so much.